Hi everyone, Adam here from Future Set Mortgage Broking. Hope you're doing well. It's Friday, so we're bringing you those mortgage tips where each week we try to debunk some of the myths and explain some of the jargon when it comes to property finance. So today we're just talking about credit card limits. So there's a lot of confusion out there sometimes with how credit card limits can affect your borrowing capacity. So the way the lenders look at it, if you have a credit card with a, say, $10,000 limit, they'll generally take that limit of $10,000, times it by 3.8%, which is $380, and add $380 to your outgoing expenses essentially each month. So for argument's sake, if you had two credit cards with say a $10,000 limit, a $15,000 limit, and then maybe another one with a $5,000 limit, obviously your sort of outgoing expenses could then sort of reach near to sort of $1,000 a month on top of what you're already spending. So that's also takes into consideration your balances as well. So even if your balance is zero, even if you pay your credit card off each month down to zero, it makes no difference. So where people sometimes get stuck is they think they have a credit card that they don't use, it's got a zero balance, and they don't declare it. Obviously, when a mortgage broker looks at your credit report, they can see these credit cards that are available, and again, have to add that into your assessment, so it can then reduce your borrowing capacity. So it's really important to understand that you need to disclose all the credit cards, but also how they might affect your borrowing capacity. Now, you don't need to go and close your credit cards as soon as you sort of get ready to sort of do an assessment. Your mortgage broker should do an assessment and see whether you can still service with the credit card limit there. So if you can't service, a good mortgage broker should say, look, if you reduce your limit down to zero or to X amount, you can then service the loans. And at that point, then you can make it a task for yourself to either close that credit card, or when you do your loan, so you're doing a refinance, you can make it a condition of settlement. So you have to close your credit card on settlement. If you've got, say, credit card balances that, say, you've got a credit card with a limit of $10,000 on it, and you've maxed it out and it's $10,000, and you're thinking, how do I pay this off? If you're doing a refinance, you can consolidate that $10,000 into your home loan. So the lender will basically give you the cash or pay off your credit card, and then you close the facility down. And that's my advice anyway. If you do have credit cards, is to do that on a refinance, because rather than spending or paying sort of 15 to 20% on interest repayments, if you consolidate into your home loan, your cash flow will improve massively, and you'll be sort of on rates of mid twos to mid threes, depending on what sort of obviously rate you end up with. So something there to sort of consider. I hope that explains it a bit more and why credit cards impact your borrowing capacity. If you're not sure about anything, obviously feel free to use the link below, book time for a chat myself, and we can discuss further and go from there. But for now though, have a great day, and I'll chat to you again soon.